Hey guys, it's Nosh here. Today we're going to address the elephant in the room. Tax, and more tax. When we own real estate, start up a corporation, or even own our own business, the question on everybody's mind is, how can I get away with paying the least amount of tax possible and keeping most of my hard-earned money? How is it that some people make an incredible amount of money but get away with paying almost nothing in taxes? We're about to dive into that, but before we do, let's get some legal stuff out of the way. I am by no means a financial advisor. I am not a CPA or tax accountant, nor am I an attorney. You as the viewer should always consult with an accountant or tax expert prior to implementing any of the strategies found on this YouTube video or any of the YouTube videos out there. The following information has been presented as a guide and should be used as such. Now, with all that being said, let's get started. Sir Robert Borden served as Canada's 8th Prime Minister from 1911 to 1920. On September 20th, 1917, the federal income tax on business profits, as well as the tax on personal income, was introduced. Initially, it was pitched to Canadians as a temporary measure to finance World War I. However, in 1949, it was made permanent. In Canada, we have two levels of income tax, the federal income tax and the provincial income tax. Make no mistake about it, apart from a divorce, taxes have the ability to be one of the largest contributing factors to the erosion of one's wealth. So it's absolutely in your best interest to take the time and understand our tax system and to understand how to work within the legal parameters to lower your tax burden. It's rather unfortunate, but all too often I see people ecstatic to receive a refund after filing for income tax. What I try to explain to people after they brag about receiving a tax refund is that receiving a refund is not actually a good thing. It's not per se a bad thing. I mean, after all, receiving a lump sum of money is a good thing. But it also means a missed opportunity. You see, what you're really getting is a portion of your own money back. The government took more than their fair share of taxes from you, but waited the entire length of the fiscal year before determining that. And they don't actually pay you that money until well in the new year. So what happened? You effectively provided the government with an interest-free loan. And remember, you're not actually able to charge the government any interest on borrowing that money from you. Even worse, the money today is worth more than the money tomorrow due to inflation. Now, things are certainly the other way around, isn't it? When you're late to file income tax or late to pay back CRA or IRS taxes owed. Perhaps a better way to demonstrate this is, let's suppose that you make a base salary of $75,000 a year, or in other words, it would work out to be $2,884 per paycheck. Now suddenly in February 2022, let's suppose that your paycheck was to increase by $3,000, whether it's through overtime or through receiving a bonus or some other means. The employer then adds that to your regular paycheck, to which they're legally obligated to hold back the taxes owed to the government. Now, notice that the government has flat out indicated that they don't trust you enough to pay your fair share in taxes, which is why they're requiring your employer to deduct those taxes automatically from your paycheck, before you even receive a penny out of your hard-earned money. But in this particular example, the $2,884 plus the additional $3,000 in payment is being combined into your paycheck, which would amount to $5,884. Now, from a tax standpoint, receiving a paycheck of $5,884 would suggest that your annual income is actually $152,984. Therefore, this would place you in a much higher tax bracket than what you would typically fall under. In this case, assuming your paycheck remained the same, at the end of the year, you would only have received $75,000, plus your additional one-time payment of $3,000 would total $78,000 that year. So now this means that in Ontario, you would fall under the marginal tax bracket of 29.65%, taking into account the provincial as well as the federal tax bracket. But that paycheck you received was not reflective of a $78,000 a year income. It was actually reflective of $152,984 a year income. So this means on that single paycheck, you did not pay the tax rate of 29.65% in taxes. Instead, you paid 41.16% in taxes. Now, that's a difference of $677 that the government took in additional funds from you back in February 2022 that they didn't have to reimburse you with until 14 months later in April 2023. So essentially, you loaned them $677 for 14 months and interest free. Now, don't lose the message in these figures. I understand that here we're talking about $677, but let's suppose you receive multiple checks with additional income added to it. We could be talking about paying up to $6,000 to $12,000 more in additional taxes than necessary, and waiting until April the following year or even May in order to receive a refund. Now, wouldn't that money be better off spent lowering the interest on some of your potential high interest debts? What if instead of your money being lent to the government for free was placed into an investment vehicle that provided you with an attractive return on your investment? Think of all the months that your money could have been working for you. A large percentage of people only think about their tax obligations once a year, that is, come tax season. However, for those who are self-employed, such as sole proprietors or those who own a corporation, they, on the other hand, likely find themselves in a far better position if they think about their taxable income and tax advantages all year long. You see, what goes through the mind of an investor is the moment we make money, the first thing we ask ourselves is how much of this money can I legally keep in my pocket? What were my costs associated with earning this money? Can any of those costs be written off to lower my tax burden? If so, it's wise that I have thorough and proper filing systems in place to ensure that I am audit proof so that I can claim such deductions and keep more of my after-tax dollars in my pocket. Now, understand that there's no point in trying to defraud the CRA or the IRS or any government tax organization for that matter. These guys are very smart and good at what they do, so my stance on this topic is that I will only pay the minimum amount of taxes that I am legally obligated to pay, nothing more and nothing less. And if I discover a taxable expense that's applicable to me, that's legal, I will absolutely make use of it. You see, these tax strategies are not just available to the rich, they're made available to everyone. It just so happens that it's the wealthy individuals that have educated themselves on the tax deductible expenses which apply to them and how to best make use of them most efficiently. Or alternatively, they likely hired a chartered professional accountant, or CPA in other words, who knows the tax laws better than most people. You see, something that appears to be common sense amongst us investors is that we hire the professionals in their specific field to become part of our team and help us in our pursuit of wealth. Tax accountants who manage tax affairs of their clients help them to keep more of their hard-earned money and give less of it away in taxes. The rich will consider the cost of hiring an accountant a necessary expense in efforts to shelter and protect the bulk of their income. And as an operating expense, of course, it's tax deductible. They recognize that the cost associated with this expense pales in comparison to the returns that they will gain. Those with a poor mindset, however, in efforts to attempt to save what little costs that they can, attempt to do their taxes online or use the services of a seasonal tax agency who handles files in bulk and may not have the knowledge, means, resources, or be able to go in depth and to understand each person's unique circumstances. Even worse, some people choose to get an early payout by these companies instead of waiting for their tax refund to come in the mail, therefore leaving money on the table in the form of cash advance fees. Let's face it, no government's going to blatantly come out and say this is how you avoid paying us taxes. It's up to the individual to find these legal tax-saving strategies and loopholes. Here's an example of this. In the Niagara Falls region, where there's an additional tax that some restaurants and vendors may charge that is referred to a tourism tax, it's automatically tacked onto your bill. But the region of Niagara will not publicly announce that it's a voluntary tax that you don't actually have to pay. You can request the restaurant or vendor to remove it completely from your bill, but those who don't know this end up paying the additional tax. Income tax is very similar, but on a much broader scale. In the US, there are far more tax-favorable strategies available for entrepreneurs and investors. Those who attempt to create and build businesses receive a large amount of support from the US government in their efforts to become successful through tax advantages. This in turn helps drive the economy and create more jobs. Unfortunately, however, within Canada, our government doesn't share the same business model. For example, within the US, a corporation pays substantially less in taxes as opposed to a private citizen. Depending on which side of the line you stand on, chances are you're likely to view this as a good thing or a bad thing. However, consider that corporations have a wide range of expenses and material costs, labor, startup fees, salaries, shareholder dividends, etc. And let's not forget that an entrepreneur takes on a substantial amount of more risk than the average employee. The tax advantages are just the right amount of incentives to encourage businesses to want to develop brick and mortar buildings within the country and to use America as their headquarters. That means that the jobs that are created end up going to Americans and thus ultimately helps fuel the economy. Canada, on the other hand, well, It prefers to heavily tax those same entrepreneurs and investors, making it much harder for corporations and private investors to want to use Canadian provinces as a means to develop warehouses and company headquarters, thus resulting in a loss of thousands of jobs and a chance to build our economy. Those companies simply take their business south of the border and offer those same high-paying jobs to Americans. Investing in real estate is considered a business. Let's assume you're like the average investor starting out. You have your primary source of income, which you earn through employment income. However, you've put money away and decided to purchase your first rental property. You are now considered to be what's known as a sole proprietor. Why? Because real estate investing is considered a business. You're purchasing real estate in the hopes of one day turning a profit in the future. As a sole proprietor, any cost that you incur to start up your business or maintain your business or even grow your business can be deducted against your total annual income. When it comes to real estate investing, almost every expense that you incur pertaining to your rental properties can be tax deductible. So let's suppose that you rent out your property and receive a gross, or in other words total income of $3,000 per month in rent, or in other words $36,000 a year, out of which you have monthly expenses such as property tax, mortgage insurance, home insurance, property management, hiring a consultant like myself for a one-on-one consultation, attending one of my real estate investment courses, repairs such as a hole in the wall, gas traveling to and from the property, cleaning supplies for when the tenant moves out, advertising fees to attract a new tenant, or garbage disposal for items left behind at the property. Perhaps even that truck that you're using for a portion or entirely for your rental properties. The utility costs associated with the property. Now, let's suppose that all of your costs associated with this property amounted to $2,000 per month. It would mean that you walk away with $1,000 per month in profits. Now, some people may have heard of depreciating a property. Now, depending on where you live and the tax laws that are applicable in that area, this may be a huge advantage or it could be your worst nightmare. You see, depreciation is a term that describes an asset to lose its monetary value over a period of time, to the point where the asset is ultimately believed to be worth $0. In the US, it's called depreciation, and in Canada we refer to it as capital cost allowance, but really it means the same thing. The same way we can effectively claim the deduction on our vehicle, which is a big tax advantage by the way, we can also do this on our home. If you live in the United States, the time frame that the IRS deems your house to depreciate from the purchase price to having $0 in value is 27.5 years. So now let's suppose you purchased your house for, let's say, $500,000. On paper, 27 and a half years later, according to the IRS, your house is now worth $0. That's like saying your house depreciated in value over the course of 27 and a half years from $500,000 down to nothing. So we divide 500,000 by 27.5, which gives us $18,181. Now, in this example, we had $12,000 in profit per year. So even though we have that $12,000 in our hands, on paper, we can show a loss of $18,181. The difference in this case is $6,181, thus placing us in a favorable position for a tax refund. So every year that your house loses value, you can use that towards your annual tax deduction. And this is huge because the United States has something called the 1031 exchange. That means that if you sell your property and you buy a property of similar value or higher, you can purchase that property without paying the taxes from the sale of your existing property and defer it into the future years. Theoretically, you could keep deferring this all the way until you ultimately die. To which point, if your real estate portfolio was structured in such a way, you could essentially have your portfolio transferred to your beneficiaries tax-free. This is how people in the States can purchase million-dollar mansions on paper and declare that they're making a loss, effectively getting away with paying no or little in taxes. Now, that's in the States. Remember, we talked about Canada being unattractive for entrepreneurs and investors alike. In Canada, we don't have a 1031 exchange. So if you depreciate your property in Canada, which by the way is an election, meaning you can choose to take it or not. However, if you choose to, it must be done over a course of 40 years and not 27.5 like our neighbors. This means we can't deduct as much in any given year. And even harder on the pocket is that furthermore in Canada, you're limited to deducting a certain percent of capital cost allowance or depreciation per year. For rental properties, that amount is 4%. In Canada as well, you cannot use capital cost allowance to show a loss. You can use it to bring your balance down to zero or break even, But if it was to show a loss, you would have to delay utilizing that deduction into a future year when you perhaps bring it to zero or show a profit. So if you're thinking right off the hop, capital cost allowance compared to the US depreciation is almost the complete opposite, you're quite likely right. Now, as a result of there not being a 1031 exchange in Canada, when you go to sell your property, if you had claimed depreciation, there will be something called a recapture. And now that means that your property was said to be worth less and less every year on paper. But as it turns out, when you sold your property, you sold it for more than what you purchased it for. So every year that you claim capital cost allowance on your tax returns, you now owe that money back. But in addition, you still owe capital gains. If you have a principal residence, you benefit from the capital gains exemption. So when you sell your property, you don't actually have to pay taxes on any of the profits that you realize. Now, here's an important part. If you claimed capital cost allowance on your principal residence, when it comes time to selling, you will no longer have the capital gains exemption. And therefore, when you sell even your principal residence, you will be expected to pay capital gains on that. All of this gets added to your annual income tax for that tax year. So let's not forget, this is going to likely place you in a much higher tax bracket, and who knows what the tax rates are going to be 40 years from now. Now, some advocates of the capital cost allowance will argue that your money is worth more today than it is tomorrow. So why not take that money today and invest it? Now, as much as I agree with them about the money being worth more today than it's worth tomorrow, and there's validity in that argument, I can't say with certainty that I know what the government's tax rate is going to be in 25 years' time. It may be the same, or the government may have chosen to increase their tax rate, and now the cost of kicking the can further down the road, so to speak, just became more expensive than I would have otherwise bargained for. In either case, something that should be considered is whether the property now, or perhaps in the future, will ever be used as your principal residence. Now, if you're informed of the Canadian tax laws, you might be quick to raise the question of a creative structure in a Section 85 rollover. For those of you who don't know what that is, anytime you transfer an asset, such as a property, from one person to another, like from you to your child, the Canadian tax system deems it to be a sale of that property, and therefore you would have to pay taxes on the transfer of that property, not based on how much you sell it to him or her for, but based on the fair market value. A Section 85 rollover, however, allows you to transfer your property that you own in your own personal name into a Canadian corporation that may have multiple shareholders, like, for example, you, your spouse, your children, etc. And when you transfer the property to the corporation, you can defer the taxes on that transfer. Now, this is simplified for explanation purposes, and if this is something that you're interested in, it's advisable to reach out to a certified accountant for further clarification, as in order to be eligible for a Section 85 rollover, your property must first qualify. So you might be wondering, what actually qualifies as a business in Canada? Well, in Canada, the CRA defines a business as one that is engaged in a commercial activity with a reasonable expectation of turning a profit, either in the immediate or foreseeable future. For most businesses, it is acceptable that losses can occur for the initial 2 to 3 years it takes for a business to start up. However, after that, for a business to in fact stay in business, a profit typically needs to be made. The Canadian government has made it very clear that they intend to tax corporations much in the same way that they tax private individuals. This ultimately drives away businesses and ends up stunting our economy and citizens. Just take Pfizer, for example. Many other developed countries like the US and Belgium have their own vaccine production facilities. This means that COVID-19 vaccines went out to residents in those countries first, before Canadians had an opportunity to be immunized. During an interview with the West Block's Mercedes Stephenson, the president and CEO of Pfizer Canada, Mr. Cole Pinal, was asked about why Pfizer COVID-19 vaccines wasn't being made in Canada and what was holding the industry back from building these kinds of development facilities. Mr. Cole Pinal answered,
"We'd really like to partner with the government to find ways to change their current policies that really deter the capital investment that brings innovative technology in the pharmaceutical sector to Canada."
So, what does having tax-deductible expenses mean in layman's terms? Tax-deductible expenses refer to an expense which someone can use to lower their annual income for tax purposes, thus effectively reducing the amount of income which they are required to pay taxes on. It can also reduce the marginal tax bracket that an individual may fall under. So, supposing you had an annual income of, let's say, $100,000 a year, you would naturally be required to pay the marginal tax rate on that $100,000 a year of income. which in Ontario would mean that you would pay an average marginal tax rate of 37.16%. However, let's suppose that you now have $20,000 in tax-deductible expenses. You would use those expenses when filing for your taxes, effectively reducing your income from $100,000 down to $80,000 as a result. Therefore, now you're only paying taxes on $80,000 instead of $100,000. This would also mean that you fall into a lower tax bracket. So now, the more expenses that you're able to write off against your annual income, the greater the chances of having more money remain in your pocket as opposed to the government's, and allowing that money to be reinvested into your company or to grow your company or placed in an investment vehicle to increase your overall wealth. A general rule of thumb is for any property you purchase, half of the value of that property is what you're likely to pay in interest over the full 25-year amortization period. So in other words, if you purchase a house, you're actually buying one house for you and you're buying one half of your house for the bank. So let's suppose you took out a mortgage of $500,000. Amortized over a period of, let's say, 25 years at 3%, your monthly mortgage payments would amount to roughly $2,108. In the first year, $858 would be applied towards your principal balance, and $1,250 would be paid to the bank in the form of interest. Now multiply that by 12 months, and you would be paying roughly $15,000 in the first year in the form of mortgage interest. Now, did you know that the interest you pay on any business loan is tax deductible? So because a mortgage is considered a business loan if it's for a rental property, the amount that you pay in mortgage interest on the rental property is 100% tax deductible. But now, what if you never learned this? For example, if you never realized that this tax advantage existed, by not using the $258,000 as a tax deductible expense over the lifetime of the mortgage, you'd essentially be paying taxes on that. And that's just one potential error on its own. So what was the cost of hiring a tax accountant for 1 year to potentially arrange your financial affairs and educate you on the tax strategies available? Roughly $400 a year, or $10,000 over the course of 25 years. And needless to say, because it'd be considered a business expense, even the cost of hiring the professional accountant is tax deductible. Now, surveys and studies have found that the number of Canadians who are adopting the DIY approach when it comes to filing their own taxes is increasing. Now, speaking from personal experience, there's nothing wrong with filing your taxes on your own. But the person who ultimately has the most knowledge is often the one who financially benefits the most. Everyone's circumstances may be different, and there may be many different variables to consider. It's true that the vast majority of Canadians who do their own taxes are in fact leaving money on the table in unused tax advantage claims. The problem is if you never have anyone correct you, then every subsequent year you're likely to repeat the same mistake. Let's talk about speculation tax for a moment here. Speculation tax was adopted by the BC government and first implemented on December 31st, 2018. Now, as of 2019, the BC government taxed homeowners 2% of the property's assessed value every year, and this was done to foreigners who own properties in certain jurisdictions in BC. Now, on the surface, this speculation tax might appear to be very favorable to Canadians. Politicians will in fact bundle this concept up and sell it to Canadians as though it's going to keep foreign investment out and make housing more affordable for the average Canadian. Now, after all, BC real estate prices have skyrocketed, and there's no doubt that people from China and Hong Kong have in fact purchased real estate in the Vancouver region, which has contributed to driving up the price of real estate. Now, this frenzy has also spilled over into other real estate markets within the country, like Toronto, Quebec, and even Calgary. With all the violence and tension in Hong Kong, foreigners have long feared for the safety and security of their money. They needed a place to park it, somewhere where it was going to be safe, protected against inflation and the volatility of the market. And if it so happened to grow over a period of time, that was merely icing on the cake. Hong Kong nationals with Canadian citizenship quickly realized that the Vancouver real estate market was not only a safe investment, but would actually allow their money to grow over the years, as the price of real estate in Vancouver was sure to rise. Now, many of these foreigners were actually wealthy enough to simply just purchase a downtown condo in Vancouver while living abroad and without the need to rent it out. Sure, they would be struck with paying vacancy taxes imposed by the BC government, but to them that's simply a cost of doing business and to ensure that their money's kept safe. Now, as more and more foreign investors followed, the demand went up and the supply went down, thus inflating the price of real estate in Vancouver. Canadians making the average Canadian salary quickly found themselves priced out of the Vancouver real estate market. The speculation suggests that anyone who owns real estate in Vancouver, but is not a resident of Canada, so that means that they've lived outside of Canada for longer than 6 months, is considered to be intentionally holding on to the property with the sole purpose of selling it within 1 to 2 years for a profit. What this means for BC homeowners in certain jurisdictions is that if you're not living in Canada for a term of 180 days or more, when you file for speculation tax declaration, you will be charged a speculation tax of 2% of the value of your property, which is due each year on or before July 2nd. Now, let's suppose that you and your spouse purchased a property in downtown Vancouver, and you purchased it when prices were low, and now the prices have increased to, let's say, $3 million. It would mean that your additional tax burden would amount to $60,000 per year, assuming that you left Canada for longer than 180 consecutive days. No exceptions. The BC government effectively painted every single Canadian with the same brush. Now, even those investors who purchased real estate in Vancouver decades ago and having held onto it as an investment property, perhaps to create wealth in retirement, yet they are punished with the same speculation tax that was triggered by a very, very small minority of people as a way to protect foreign capital. As of November 30th, 2020, the Trudeau government announced that they will spend 2021 undergoing measures to implement the speculation tax nationwide. And you see, vacancy tax is a tax that the previous Harper government announced that they will be implementing across all provinces and territories. Thank you guys for watching part 1 of my tax and real estate video. Be sure to check out part 2 as we go over the various tax incentives to owning real estate, such as salaries, home office expenses, vehicle deductions, and much more. If you haven't already, be sure to hit the like and subscribe button down below. It's completely free to you, but it really helps me out a lot.